And who would have expected this? 100 points on Nifty. You're watching Market Movers, and I'm Ashu Dutt. And really, one has to wonder why the 100 points came, because usually a gap up opening is driven by some kind of motivation, some major event around the world, some fall in currency, some increase in interest rates. So I can just make a wild guess that maybe it's just insurance companies or government-owned insurance companies. Maybe it's the index, but I've got no idea why all of a sudden the index needed to open with a gap up of 70. So now let's see what's really happened. So if the index opened with a gap up of 70, that means even if you got in, you made only about 20 points on the Nifty, because there was no chance of you getting in at 75. So basically the starting, that means whoever put the first quote made sure that the quote was so high in the gap that nobody got in. So while it looks like the index is up 91, please do recollect it opened at around 70, 72. So only 20 points were made by whoever has managed to get in, because at that point, obviously nobody would have gotten in. So what do we have? Again, financial services stocks, as we've been discussing. So amongst financial services, what do we have? IIFL Holdings, can we bring that? Also Edelweiss. Apart from that, really, Oracle used to be the old iFlex. It really never moves. Maybe today it's got some momentum. Allahabad Bank, that one's also strong. ICICI, Shrey, Indian Overseas, SBI, Shriram Transport Finance. So that's the usual suspects that you usually have. All right, Avinash Guraskar is with us for the fundamental side of the market. Amar Singh of Angel Broking for the technicals. Amar, thanks very much for joining us. Just overall, the way the markets closed yesterday, could you walk us through what do you think triggered the market to open with a gap up of 70? Because nothing really transpired, between that closing of the market and opening. All right, is Avinash there? All right, so we can go to Avinash. So Avinash, good morning. We saw about 100-point move in the Nifty, but again, I don't want to call it 100-point because the gap up itself was at 70. So actually, it's a 20-point move from there. But what do you think happened? Obviously, investors as a group don't change their mind, from a closing at 4 o'clock to a opening at 9 o'clock. What do you attribute this to? All right, Amar, let me try this, and otherwise I'll go through a couple of stocks with you. So Amar, I was talking about financial services stocks, and also what do you attribute the index opening with a gap up of 70? Anything on the charts that showed that something like this was going to happen?
Yeah, actually looking at the overall the markets for the last couple of days, and yesterday the trigger was the Bank of England, which cut its rate by 25 basis points. So that was a trigger. Markets were anticipating and expecting it. But going forward, again, there is global investors view that going forward, quantitative easing would also happen in Britain. So I think that was one of the triggers. As far as the stocks are concerned, banking stocks are doing well. Axis Bank can be looked at as a buy. The region of 553, 550. 5 levels with a stop loss of 546, targeting 570 levels. So we, because yesterday was the expiry of Bank Nifty, so we saw a weakness in the banking stocks. But today, Axis Bank looks good, so that can be used as a buying opportunity. ICICI Bank is another which can be looked as a buying opportunity between 243, 245 levels. And with a stop loss of 238, targeting 260 levels. So both ICICI Bank and Axis Bank in the private space, they look good. ICICI results weren't that good, but yes, that the stock was beaten down significantly. So that should be used as a buying opportunity in the banking stocks. But it's more of a trading range that we see, because on the upside, 8700, 8711, which was the high of Nifty, that looks immediately difficult to break through, because that would be a major resistance, and that would lead to the next leg of rally up. So we have to watch out for that level. But yes, today the markets have really given a thumbs up, both on the GST as well as
right. Amar, for a minute, I'll leave GST and Brexit and all. I only want to discuss technicals with you because for a trader, all this stuff gets factored in the price somewhere. For some reason, I find this today's move a little deceptive. I'm not convinced that traders change their mind so quickly overnight, especially given that the UK is not of much significance to us. But anyway, we'll leave that on the side. I just want to ask you this. Now, people are sitting with logistics stock because that's what was sold to them because of the GST. They're sitting with sugar stocks. Now, many of these things have taken a 10, 12, 13%, maybe even 25% hit in the last 1 week to 2 weeks. What do, Amar? Should they get out of sugar? Should they get out of logistics?
That's a very pertinent question. See, generally what happens is that once the news or event happens, then there is already the market discounts the news or event by a few weeks. It goes to months also, depending upon the event. So as you rightly said that yes, those who are in profits in sugar and logistics, they should look at booking profits. Those who are not in profits, who are in some losses, then for them the advice is that today's market, the way the market has opened, Nifty is almost 100 points up. So that clearly reflects that the market could try to touch the 8,700 level. So that would be a broad-based positive sentiments from the market. So if they get an opportunity, they should look at booking profits. Because as I said earlier, that till the time 8,700 levels is not closed on a daily basis, we are not going to see the next leg of rally, and that could also mean some consolidation and profit booking at higher levels. Yeah.
So a very relevant point, and I'll just come back to you in a moment and also discuss with you a couple of mid-cap stocks. So yeah, everything is back. Tokyo Plast, Mangalam Drugs, Datamatrix, let's see, Arrow Granite, as a Kakatiya Cement. So I mean, yeah, you talk about it, and many of these stocks are Shekhawati, Polyan. So we'll get into some of those in just a moment. But Avinash Gorakhsakar is also with us. Avinash, thanks. I'll just check with you first if you can hear me clearly.
Yeah, I can hear you.
Oh, okay, Avinash. So I just wanted to first ask you, what do you think is happening in the market for the last 3 days? For 2 days, the market, I mean, it's almost, market's behavior seems psychotic. For 2 days, it just kind of went into some kind of a coma. All of a sudden, it opens with a gap up. You know, just from a volatility perspective, it makes picking a stock or being long or short as much difficult. But your thoughts?
No, actually, Ashu, you're right, because this volatility has been extremely high, and my sense is, I think, you know, a lot of sector rotation and stock rotation happens almost every 2 to 3 days, and you know, stocks go up pretty fast, they come down, then again a new sector is in demand. Overall, our sense is that now that the GST bill has been presented, I think you know, the near-term trigger for the markets would obviously be to focus on what happens on the on 9th August credit policy, because you know, GST as an event definitely was fully discounted by the market. You were mentioning about some logistics stocks some time back. My sense is these stocks may see significant amount of selling pressure, because now the focus on these companies would again be on actual hardcore earnings. And that is not going to be impacted positively, at least for the next 12 months, because hopefully this GST bill gets presented in the winter session, and hopefully, you know, only in FY18 we can see some material tangible benefit coming to these companies. But overall, I would say that, you know, it's going to be more of a stock-specific kind of strategy in this market rather than an index-specific strategy. And even today, I would presume that even if the market is opened with a gap up of 60, 70 odd points for the Nifty, clearly 8,700 is going to be a very, very strong resistance. And going beyond that, sustaining it on the kind of earnings flows, I mean, on the kind of corporate earnings which we have seen till now, have not evoked that kind of confidence. In fact, I've been not very happy with the earnings numbers, and clearly looking at the PSU bank performance, looking at numbers from Siemens, you know, frontline companies, I think clearly the liquidity flow is only pushing up the markets, and that is something which, you know, nobody has a handle on. So I would prefer to be a little cautious, and obviously, you know, only at a fairly good risk reward entry point, I would suggest buying at lower levels. Even at the current level, the risk upside, the upside to the stocks has been significant. An example is, you know, NBFC stocks, which have actually rode across the board. And buying stocks at these valuations, Ashu, is definitely not going to be a very easy option. There could be little pain ahead. So let's wait and watch. If nothing comes in the RBI policy, plus if it's a neutral kind of stance, the markets could get disappointed.
Right. I'm just going to go through a couple of stocks, if I may. Texmo Pipes. Just a one-year chart will be enough, Smita, if we have that. And then Tokyo Plast, Datamatics Global Services, Aero Granite, Kakatiya Cement, India Bulls Wholesale, V2 Retail, and Trent. So we have some kind of a momentum. So Datamatics looks like a pretty clean chart. And Datamatics, whenever it does move, you get that 15-20%. Even V2 Retail, maybe a breakout. And this time the trend is cleaner than what I've seen sometimes in the past. Trend, not bad, not a bad trend at all. I mean, if the price is correct. So, but we'll just check that out in a moment. Amar, so I just wanted to focus on the mid and small cap. See, we can worry about at some point, you know, who will buy the stocks. But at the moment, it seems like in the small caps, have the perfect storm, which is that the liquidity is, the float is low. Stocks have already gone into PMS or mutual fund holdings. So if you want to buy any more, you will see significant upsides in some of these stocks. Could that be possible, Amar, that we still see another 20, 30, 40% in small and mid caps, just given the fact that the float is lower and that maybe the stocks is already in hands who don't need to sell overnight?
Yes, that's a valid point, Ashu. The only concern that I have is that overall market sentiments do have a role to play, and it could be certain stock specific. If there is a specific news to that particular stock, or some development, the stock would go up. Otherwise, it would be the market sentiments that's going to drive the markets. And overall, the broad-based sentiment, as I've said, on the upside seems to be capped. Even if you look at the global markets, we are seeing more of consolidation. So yes, mid-cap and small-cap stocks, some of them could see, as you rightly said, that there's less float in that. But overall, I would say let's watch the overall sentiment for the today's the Friday closing, how the market closes, and Monday opening definitely would be very crucial to set the tone for the August.
Right. And we'll take a look at the Nifty once again. Because, see, the Nifty is now at some very critical levels. As I'd mentioned to you, the level really, see, depending on how you look at it, at 85.10, had the Nifty cracked below that, it would have been significant. It didn't crack. And actually, after maybe 85.45 or 85.50, the Nifty doesn't have a resistance till about 87.10. Again, depending on which chartist you talk to, that level may change a little bit. And after that, really, there's no resistance till 89.40. So we are in very good territory. So let's say we get another day where we get a similar move, then you would have crossed, and basically then you are on the last phase of the market. You know, look, as I said, there are people with many motivations in the market. Everybody doesn't have a value motivation, so something else could drive it. Amar, what is your thought? Because even from a technical resistance perspective, beyond 89.40, you know, it's anybody's guess. The momentum could take this index anywhere because we would have broken all the psychological resistances that keep a market from moving up.
That's quite true. The only thing I see is on the daily charts. The daily charts are not looking very convincing right now. So, as I said, that today's closing is going to be important, and also we would see profit booking as the risk-reward ratio now is going to be the risks comparatively on the higher side and the rewards on the downside. That could be somewhat of a concern for the investors, long-term investors, I'm saying. So for traders, that's okay because volatility would be there that would help them trade in the markets. But yes, the daily charts are not looking very convincing. However, the medium-term, long-term, they are definitely on the positive side. So we'll have to see if there's some fresh triggers because yesterday's or today's move is more on the back of the Bank of England reaction, and also that's a signal that other central banks globally, be it the Japanese bank or central bank or U.S. Federal Reserve, that's already come out that they wouldn't be going in for a rate hike most likely. So these are some issues which are going to drive the market. In the short term, yes, profit booking will come in the market. We will see volatility. How the market settles today is going to be very important because how the market opens on Monday, because that would set the trend, as I said. So yes, caution definitely should be there.
Right. Avinash, you know that in markets there are also very different kinds of markets, and usually a collapse comes in a market where there are too many retail participants, either on the investing side or trading side. One of the unique phenomenons I see of this market's rise, that even if they are retail participants, actually they have been very skeptical, and if they have been investing, they have been doing it through a mutual fund or through a PMS. So actually the game between buyers and sellers is being played by, big guys. Big guys in the sense that, it's not a guy who needs 10,000 bucks tomorrow morning or can't pay a margin. Given this nature of the market, Avinash, is it possible that, the market could have some kind of a synchronized rise without, till the time it gives an impression that, oh, nothing can actually go down? Could that phenomenon play out? Because I still don't see a whole army of retail traders or investors in this market.
Actually, Ashu, you are right, because most of the retail investors whom we talk either opt for advisory, PMS, or they go with the mutual fund route. And I think in terms of flows to the mutual funds, we have seen that flows in the last 6 months have actually increased tremendously. And that is one reason one could say safely that the retail is now looking at mutual fund as a more dependable route to actually play in the equity markets. But I think you're right. I think even within the large retail investors who actually take direct positions, I think one thing is very clear that it does not seem to be a panic rally, and it doesn't seem that, this rally is going to get, is going to stop suddenly, because the overall stock selection also has been pretty good. I think unlike penny stocks or unlike, companies which are actually not good on their fundamentals, this time the high price stocks or even maybe the medium sized stocks have actually gone up, and there has been some fundamental story to back it. So I think as long as, the retail investor plays on quality businesses, good quality managements, the only catch is at what valuations do they enter? Because clearly, the way the markets have gone up in the last, say, couple of months, in fact, July also, I would presume that, a healthy correction would definitely come in at some point of time. And, only those retail investors who have a buy and hold strategy can actually make some money in this market. For the trader retail customer, it's going to be extremely difficult because a secular trend is not seen, and even technical traders have a problem that, this kind of ups and downs actually does not give a signal as to where the market is heading. So both on the upside and downside, you need to have a fundamental positional view, if the retail industry is concerned. And clearly, I don't think there's going to be any worry as such that there's going to be a major crash or some sort of a big panic call coming. So to that extent, I think the scenario is definitely positive and healthy.
Also, Avinash, there's a psychological thing that when you have money in a mutual fund and you lose money, for some reason psychologically you feel, oh, it's cheaper now, let's buy a few more units. But when you lose money in stocks directly, it's very real. I mean, it just seems like you've lost it. Could that kind of cushion, mindsets or the fall? Because, generally mutual funds give you that feeling, oh, no problem, systematic investment plan, just continue, just keep swimming. Just your thoughts psychologically, Avinash, how this could play out, because this is not one of your .com or property or one of those rallies where everybody as an individual was in the market.
I think, Ashu, you're right. Normally when you see a 10% or a 5% correction on a direct stock which you buy, it definitely makes you, feel little, disappointed and little worried. Unlike a mutual fund where, the NAV going down by a few, rupees is not something which most of the mutual fund investors actually track on a day-to-day basis. And I think guys who put money on the mutual fund actually take a slightly medium-term call. Retail investors who put money directly on the equity route are typically momentum traders, short-term kind of investors who look at a 3-month, 6-month kind of time window. So clearly the returns are good, but the risks are also high. So I mean, people who actually don't have a very high risk appetite have been preferring the mutual fund route. And I think, going ahead, if you look at the long-term story for India, I think the SIP route is obviously more favorable. But my personal view is that, in a rising market, actually the SIP route also might go against them because you actually increase your average cost of buying. So unless you have got a 5-year or a 10-year view, only then, these kind of strategies work. But clearly in the kind of current volatile scenario, it's always better to take a 3 to 4 year view because you never know what can happen beyond that. Taking a 5-year or 10-year view on a company may actually, be disastrous, if something in between happens. So So I think overall, mutual fund business will continue. I mean, from pockets where less information is spread out, people don't see channels like you, or they don't talk to knowledgeable advisors. There the mutual fund business is definitely going to go, because for them, playing on the direct equity is completely, going into some unknown territory.
Right, Amar, let me just get back to a couple of stocks. Now, let's say I'm a trader, or I like trading part time, and sometimes I'm in the office, let's say, and sometimes I'm trying to trade. And then, somewhere in the fleeting glance, I heard buy chemical stocks because chemical stocks will run up. And then I check my portfolio after 3 days, which you should not do as a trader, but that's pretty much what happens. And I say, what happened to chemicals? Same with sugar, same with logistics. So, Amar, what I was trying to drive at is that, is this really a market for what we call the part-time trader who switches on TV at some point, buys a stock at some point? Or you really have to be on the ball, because the sectors are changing with such speed that if you were in chemicals yesterday, you would have losses right now.
Yeah, that's correct. Actually, who says that making money is easy in the markets? So people should get out of this mentality, because if one really needs to or wants to make money in the markets, then one has to spend some time, because it's simply not possible to not spend time and then look at buying any stock. Yes, if they are having some advice which is coming to them and they follow it diligently and with discipline, because the markets are extremely volatile, so somewhere or the other the losses should also be capped. So that's something which investors definitely need to learn, traders definitely need to learn, because that will help them get back into the market fast. Otherwise, it could be a large loss, and then they are psychologically, emotionally, and financially they are hit hard, and then it's difficult for them to come out of that frame of mind. So yes, it is there that they will have to do some research. Yes, at the same time, we'll be getting research from advisors from the different companies. So they should look at that, but at the same time, if possible, they should do. If they really don't have that much time to do, then it's their decision as to how they want to go about it. One, and secondly, what is the risk appetite? What's the risk profile? Because those who are into the markets, those who are trading, for example, in cash markets, they have a different risk profile. Those who are trading in futures and options, they have a different risk profile. So understanding one's risk profile is very important. Secondly, the time horizon that one is looking at, either trading or investing, that's very important. And thirdly, does one have the time to really understand the markets, both on the fundamental or technical? Whether one is trading fundamentally, then basically you have a long-term view. If you're trading short-term or medium-term, it could be a technical view as well.
Right. So, Amar, you are being kind about risk profile. The only risk profile I know is that people think there's going to be no losses. Just give me the money tomorrow morning, whatever it is. Just show me the profits, whatever my risk profile is. But I just wanted to take this Ugar Sugar Works as an example. See, this is the problem. I mean, you see, when the sugar stocks were going up, everything was going up. This Ugar now again is on a 5% freeze. And at what level? 7,000 shares traded. So on the downside, see, and you're not going to know. Whoever had to get out, whoever needed to get out has gotten out. So now who are you going to sell to? And so I'm just giving this to you as an example about how careful you have to be. So if you're working and you think this is some part-time thing, in this kind of market, you will have serious losses. So please either leave it to your broker or somebody, or, maybe if you're full-time, then it may be all right. So Amar, let me ask you this. Could you pick 3 strong momentum stocks that one could buy, one on the day trade side and one on the futures side with margin? And on the futures side, something you can recommend where I don't get a margin call in the morning and I say, oh God, what is this? So 3 day trades and 3, futures. I mean, technical calls, but on something that I can buy on margin on the futures side.
See, on the cash side, one can look at buying K in India. You have to have tight stops. 190, 293 could be the range for that, with a stop loss of 187 targeting 202 levels. Whereas on the futures side, one can look at the best part is that one can go short there. So one can look at going short in Jubilant Foodworks in the range of 1160 or so, with a stop loss of 1182 targeting 1130 levels. So these are what I would suggest in the short term. Yeah.
Avinash, we may have time for just maybe a question or two. So I wanted to ask you about, some of these financial services stocks once more, but I'm going to separate them. You've got a group, the banks, and I want to keep the banks separate because they are heavily regulated. It's not like banks can, generally it's not like what they can do with the balance sheet. Usually they can do whatever they want with their customers because we have no place to report it. But otherwise on the balance sheet, I'm sure they're fine. Then you have these non-banking financial companies and, obviously they're lending to people whose risk is not good enough to go to a bank. And third, you have brokerage firms that have now essentially tried to morph themselves into home finance and this finance and that finance. Can you tell us, Avinash, why is it that those who are lending to the most risky people, those whom even a bank wouldn't give a loan, are starting to get valuations that are 5 to 6 times in market cap as compared to a bank? The entire circle seems upside down.
I think, Ashu, you're right because, I think as it is, I think if you take the private sector banks or the PSU banks, I think one clear indication, how the NBFCs have eaten into the business of both private and PSU banks is that PSU banks have been saddled with very poor asset quality and they are grappling with their own asset quality kind of recovery problem. As far as the private sector banks is concerned, for a long time, these banks were not considered to be as bad as PSU. But now looking at the numbers from Axis Bank and the watch list from ICICI Bank, I think clearly, very strongly, we believe that within large corporates, there are many private sector banks which have got stuck up and the money is not coming. So this is one basic advantage which the NBFCs have actually taken. And as you rightly mentioned, their main borrowers are the retail borrower whose risk profile may not match of a PSU or a private sector bank. But clearly, I think in segments like consumer durable financing or maybe a two-wheeler financing, a housing financing, these are reasonably stable assets. I think the problem arises in loan against property. And I think whichever companies are largely present on the loan against property vertical could possibly face, significant asset quality issues, maybe not now, but going forward. And as far as the broking business is concerned, with the roaring equity market, I think obviously, these broking companies have obviously got multiples re-rated and obviously volumes have also come into them.
Sure.
But clearly the recent RBI decision to actually give small banks approval and possibly, companies like Edelweiss or maybe a stock like Motilal Oswal, people are now assuming that these companies could obviously look at banks. Right. But that could be a different ball game. So I would presume that, currently you should be very careful. Look at the stocks from a long-term perspective.
Yes, Avinash, unlike technical rallies, market movers doesn't have a rally. It's got 30 minutes. So we're going to close it. Thank you, Avinash. Always a pleasure to speak to you. Amar, always a pleasure to speak to you. Thank you for your technical views. Market Movers comes to an end. Chairman and Managing Director of Arvind will be on Corporate Eye. Deep and Errol will be speaking to him. That's Sanjay Lalba. You absolutely want to hear what's going on in textiles. And of course, they stand out because they got tons of brands. And Ravi Chawla, Managing Director of Gulf Oil Lubricants on earnings. Goodbye.